Hi, it's Nero here, author of the book Wake Up Wealthier, How to Build a Property Portfolio that Pays Your Income Every Month. And in this video, I want to talk about the 3 reasons why I don't believe the Sydney and Melbourne markets are about to start their next price boom. Now, we know over the last 2 years, the Sydney and Melbourne markets have had their biggest drops in price in recorded history. And now we've seen interest rates being dropped. And the question is, well, is now the time to buy? Are our 2 biggest markets, after the biggest price falls of the last couple of years, are they about to kickstart their next boom? And I'm going to share with you in this video the 3 reasons why I believe the answer to that question is a resounding no. Now, mind you, I'm not saying that the interest rate drops are bad for the market. In fact, I think what you're going to see over the next 2 years is that if there are any price falls, those price falls will be far less than what we've seen over the last couple of years. So the price falls, the impact of everything that we've seen over the last few years in Sydney and Melbourne market, the worst of it is over. So that's the good news. But let's look at why I don't think the prices are going to rise steeply. Yes, there'll be some suburbs that have a little bit of growth, but overall I think you'll see some suburbs even still start to fall, and generally speaking the growth will be fairly negligible. Now, I do have some notes here because I really want to give you some hard data and facts behind my opinion and what I'm saying here. All right, so number 1, there's a huge bias against overseas investors. I'm not saying that's bad or good, I'm just talking about how things stand. What do I mean by that? Well, we have current policies that penalise overseas investors who buy in Australia they've got to pay more in stamp duty. There are tougher lending restrictions to offshore investors, and there are also restrictions on the percentage of units in a new apartment block that overseas investors can buy. In fact, according to the Australian Bureau of Statistics, lending to overseas investors has dropped 45.4%, and according to the chief economist at realestate.com.au, buyers from China have dropped 60% in just the last 12 months to the lowest levels ever recorded. Now, here's the thing. What was the primary reason that prices in Sydney and Melbourne rose so sharply between about 2012 to 2017? Was it that all of a sudden, people were sitting around in Sydney and Melbourne and at the same day and the same time decided they need to rush in and buy property? No. The primary reason was because of the demand from overseas investors, primarily China. Okay, for example, have you ever been to an auction? Did you ever go to an auction between 2012 to 2017 and you find yourself competing with an agent who's on the phone to someone primarily from China who's willing to buy the property and pay almost any price without even seeing the property? Right? If you've had that experience, you know what I'm talking about. That was rampant. And so we had so many people living in Sydney and Melbourne who would literally take their loan pre-approval, written pre-approval for whatever the price was, and go and give it to the local agent and saying, look, here's my pre-approval. For example, let's say, here's my pre-approval for $1.2 million from, say, CBA, for example. Can I get the property for this? That's how they were negotiating. They were pleading, right? Because that's all they could afford, because they were being pushed out of the market by people from overseas buying up a local property. But that has now essentially dried up to a barely even a trickle. So we don't have that surplus demand from overseas buyers. And why though is that going to have the biggest impact on Sydney and Melbourne? Because Sydney and Melbourne had the lion's share of all the overseas buyers who are buying up property. The demand from overseas did not have as big an impact on any of our other cities and any of our other markets around Australia. So while those constraints are in place, while the demand from overseas investors and overseas buyers is artificially muted, and I say artificially because I'm fairly certain that people from China and many of the other countries, they still want to buy property in Australia, either to invest in, for their kids, to live in, whatever the case is. That demand hasn't gone away. However, it's the current policies, the current lending restrictions that have put a stop to that. And I don't know when that's going to change. Again, this is not saying that's good or bad, it's just the way it is. So if you're buying property expecting all this huge demand, the question is, where's that demand going to come from? In the previous boom, it came from overseas buyers. That's essentially been taken away. So what's going to give you that excess demand now? And talking about demand and supply, that brings us to the second reason why I don't believe there's going to be a huge price growth in Sydney and Melbourne. And that's this. There's still a huge oversupply in the unit market. All right, so they're still building lots of apartments, there's still lots of cranes in the air, but with the demand from overseas drying up, as I just said, with banks being more and more hesitant to lend to people looking to buy units, especially off the plan units, even completed units, the demand is still nowhere near what the supply is out there. I still think it's going to take another 18 months to 2 years for this oversupply issue that we have, especially in Sydney and Melbourne, to be mopped up, okay? And that's reflected quite obviously in the vacancy rates of certain suburbs. When you look at a market, and one of the things that you're looking for when you're looking to buy an investment property is you want to give yourself the best chance of getting the property rented as quickly as possible and getting some good rental returns. And if you want to do that, you want to look at the vacancy rate. And one of the things that I look at is that has the suburb got a vacancy rate of under or over 3%? Because if you buy in a market that has a vacancy rate over 3%, that means you're essentially buying in a market where there are more properties available than people looking to rent those properties. And if you buy in those kind of markets, you're going to struggle to get your property rented, and you're going to struggle to get capital growth because there's more supply than demand. Okay, so for example, if we look at Liverpool right now, the vacancy rate has risen to 4.3%, and it's still rising. Rouse Hill, vacancy rate is currently 7.3%. This is as of June 2019. All right, so really high. Mind you, that's coming off where it was a couple of months ago. It was sitting at about 11%. Then we have Macquarie Park. Again, a few months ago, it was sitting at 12%, which means I think roughly 1 in 8 properties were sitting there vacant. And now it's still sitting at 7.1%. So with these really hideous vacancy rates, the challenge you're going to have is when you buy into these markets, you're not going to get the returns that you want, especially over the coming few years. All right, and so remember, the fundamental reason behind price growth is that demand has to be more than supply. And while you have demand being less than supply, which is what an oversupply issue means, you're going to struggle to get the price growth, especially in those, I guess, more affordable price points that we have in and around Sydney and Melbourne. And then the biggest reason of all, and this is something that I hardly ever see people talk about, is this: affordability. See, although the price drops in Sydney and Melbourne over the last 2 years have been the biggest on recorded history, and every man and their dog who's looking for headlines have been coming out talking about the biggest price crash, and it's going to be a price crash, and blood on the floor, and blah, blah, blah. If you've been following my work, you know I've been saying that there will be no price crash, property price crash in Sydney and Melbourne. Prices will fall, but they will hit a place where they're going to plateau, and we're seeing that right now. Right, the rate at which prices dropping is slowing down significantly. Yes, I expect that in many areas prices will still have further to fall, but it's not going to go back to where prices were in, say, 2011, 2012, before the price boom started. And so therefore, with the fact that prices are still quite high, in fact, the average property price is still out of reach for the average person living in our two biggest markets. And with wage growth essentially stalling and there being none of it, and that's been a big factor contributing towards why we've seen interest rates being dropped. The question is, if people can't afford prices today, how likely is it they can afford higher prices tomorrow? But it just doesn't make sense, right? If you can't afford $100 today, for example, could you afford $102 tomorrow? Just when I put it that way, it seems very obvious, but I see so many people not considering whether the average person in the area, people who are buying, can they afford prices to rise. So they're the 3 reasons why I believe the Sydney and Melbourne markets are not going to be booming anytime soon. Now, does that mean though that you don't invest at all? No. What you need to do if you're looking to invest in property is find a market that does 3 things. Number 1, you find a market where affordability is not an issue, where the average wage of people living in that area allows them to easily afford the average property price. in that area. Because when you have good affordability, then if prices are to rise, well, it's easier for the average person to afford them. So look for good affordability. Number two, look for an area where there's greater demand than supply. And that make sure that demand is being driven by people who want to move in and live in that area. Okay, because if you've got more demand than supply, well, and also good affordability, all else being equal, prices are more likely to rise. And then number three, for long-term growth, ensure that there's good job creating infrastructure around the area to support the population growth. If you can find a market that does those three things, look, there are no guarantees here, there's no crystal ball obviously, but if you can find a market rather that can do those three things, great demand and supply, good affordability, good job creating infrastructure, you have stacked the odds in your favor of getting good capital growth over the coming few years while also making it easy to get your property rented. Hey, thanks so much for watching. If you liked this video and you found it valuable and you're thinking you might like my help to help you find an investment property, then head on over to nerocall.com. That's nerocall.com for a free case study, and then if you like what you see, you can book in for a free half-hour phone consult with me personally, where you can find out more about whether I'm the right person to help you with your property investing. Either way, thanks again for watching.